Hello and welcome to the Bougie Banker. I've been looking for the opportune time to launch this channel, and I think it's finally come with the collapse of Silicon Valley Bank. So I want to talk a little bit today about the history of Silicon Valley Bank in general, what causes a bank to collapse, and then what the various stakeholders, creditors, depositors, etc., can expect from the process that the bank is now in. So first off, Silicon Valley Bank is a bank that's been around for about 40 years. It has been focused on the tech industry and tech adjacent fields like venture capital and private equity. And it's maintained that industry focus even as it expanded globally. It now operates in several different countries around the world, but still serving tech companies in all of those countries. More recently, they've tried to diversify their clientele by expanding into Napa Valley, but that is still a very small piece of their business, and they're primarily tech-centric. Now, how this became a problem, and what you often see in the case of a bank collapse, is a bank that has become overly focused, usually on a specific locale. So you see this quite often in community banks, where they're in a small town somewhere in the country. That small town has one or two big employers. The employer pulls out of the town, the bank goes under. Here it's a little different because they had a focus on a single industry, and their fortunes wax and wane with that industry. The unfortunate thing now is, this bank survived the crash of '87. They survived the tech bubble burst in 2000. They survived the global financial crisis. But there is a confluence of factors right now where the tech industry is in trouble. At the same time, interest rates are rising. So what the bank is seeing is a loss of capital because withdrawals are exceeding deposits. At the same time, some of their investments in treasury bonds are losing value because they bought those bonds at low interest rates. Interest rates rose. When interest rates rise, bonds lose value. So the confluence of these factors caused the bank to come out and say on Wednesday of this week that they were looking for a capital infusion. Now, those of us who remember the financial crisis are very, very scared by those words because so many rules and regulations were put up around capital sufficiency after the financial crisis. So when a bank comes out and says they're seeking a capital infusion, people who do business with the bank tend to panic, and that's exactly what happened on Thursday. So folks who had deposits in the bank, logged into their app. So many people were doing that. The app crashed. They logged into the website. So many people were doing that. The website crashed. They decided to call customer service. So many people were doing that. They couldn't get through. And then lines started forming at the doors of the bank's branches as more and more of the depositors were trying to get their money out. Many were successful, but at the end of the day, so many had moved their money out of the bank that the bank's cash reserve flipped negative at the end of the day, which caused regulators to step in first thing Friday morning and shut the bank down. So what does that mean? What does that mean for remaining depositors? We'll start there. So smaller depositors, those who have $250,000 or less on deposit with the bank, the FDIC has come out and said you can withdraw your money on Monday. They will make the capital available to you. Those who have deposits in excess of the $250,000 of FDIC insurance will soon be receiving a preliminary dividend payment from the FDIC. What the FDIC has to do in this case is start liquidating the assets of the bank. As they liquidate the assets of the bank, they'll start paying depositors back. But what you never see in a situation like this is assets exceeding the value of the bank's liabilities to depositors. So typically, the depositors who aren't insured will receive about 70 cents on the dollar. Could be more, could be less. It all depends on how successful the FDIC is in liquidating the bank's assets. Next down the ladder is creditors. So folks that the bank owes money to, they're most likely not going to see a penny. Since the bank isn't going to have enough to pay depositors, and the depositors are at the top of the ladder in terms of receiving any cash payouts, creditors are just going to be out of luck. Next down the ladder is the shareholders. Shareholders only get paid, so this is the people who own the stock of the bank. Shareholders only get paid if the assets of the bank exceed the bank's liabilities, and that's not going to be the case in this type of situation. So most likely shareholders will see absolutely nothing. Employees of the bank, if you were an employee of Silicon Valley Bank, the FDIC has come out and said that they will continue to pay employees for 45 days to continue working to ensure a proper wind down of the bank's business. But unless they find someone else who's willing to come in, buy all the branches, keep all the people, most likely all of the employees will no longer be employed after 45 days. And the final group that I'll mention is directors and officers. So directors and officers of the bank, these are the people in the C-suite, the people who are on the board of directors, the people who run and oversee the bank day to day. Whether there's been any wrongdoing or not, they're going to be made the villains of this story. There will be congressional hearings about this. They will be summoned before Congress. They will be vilified by Senator Warren. And the unfortunate thing is directors and officers are fiduciaries of the bank. So unfortunate for them, fortunate for everyone else. So most likely, the directors and officers are going to be sued by everyone else. The depositors, the creditors, the shareholders, and they could even see criminal charges out of this. All of their trading in the bank shares will be examined, and all of their deposit actions and withdrawals will be scrutinized. And if any determination of wrongdoing is made by regulators, there's going to be criminal charges filed. But criminal charges, civil charges, it's going to be a very, very bad few years for the directors and officers. Oh, I didn't mention I mentioned with the depositors, the uninsured depositors. They'll expect something on the order of 70% back, but it won't be quick. That will be over the course of several months. So they'll receive one dividend payment quickly, possibly this week. But then it depends on the pace at which the FDIC can liquidate the bank's other assets, and that will determine when they receive other dividends in the future. All right, so that's a little bit about Silicon Valley Bank. What caused this situation, and what tends to cause this situation for other banks that collapse, and what the various stakeholders can expect from here on out as the bank's business is unwound. So thank you for joining.